$13.5 billion.
It's a number that is genuinely hard to wrap your head around.
It really is. And I want to start right there because I need everyone listening to understand exactly what that number represents. That isn't revenue. It's not the company's valuation.
No.
That is a net loss. And get this, it isn't over a decade of R&D. It's not even over a full calendar year. That is the net loss posted by OpenAI just in the first half of 2025.
It's a figure that just stops you in your tracks. I mean, in the world of startups, burning cash is normal.
Yeah.
But this is arguably unprecedented.
It absolutely is. Welcome back to the Deep Dive. Today, we are unpacking a situation that feels like it's flashing code red on every financial dashboard in Silicon Valley. We've pulled together a massive stack of reports, financial analysis from Deutsche Bank, market projections from Bain & Company, legal filings, and some very heated interviews to answer a single burning question. Is the AI bubble finally bursting?
It is the question of the year. You know, maybe the question of the decade.
We're talking about the reported financial implosion at OpenAI, a hardware crisis that is likely making your next laptop unaffordable, and a war of words between CEO Sam Altman and some very loud, very skeptical investors.
It's a classic tension. It really is. On one side, you have Sam Altman telling the world to, short the stock if they dare, projecting massive growth.
Right.
And on the other, you have veteran investors like George Noble screaming from the rooftops that the company is falling apart in real time.
Exactly. So our mission today is to look past the headlines. We're not just talking about corporate finance here. We're investigating whether the AI hype cycle has actually peaked, why consumer electronics are suddenly skyrocketing in price, and this is the scary part, whether we are staring down the barrel of a tech bubble burst that looks suspiciously and terrifyingly like the 2008 housing crash.
And that comparison to 2008, it is not one to make lightly. But when you look at the sources we have today, the structural systemic risks are becoming harder and harder to ignore.
Okay, let's start with that black hole of money. I mentioned the $13.5 billion loss in the first half of 2025. Help us contextualize that. Because in tech, burning cash to grow is standard procedure. Amazon did it. Uber did it. Why is this different?
It's different because of the velocity, the sheer speed of the burn. Analysts had originally projected a $14 billion loss for the entirety of 2026.
The whole year.
The whole year. OpenAI nearly hit that number in just 6 months.
So they're running ahead of schedule, but in the worst possible way.
Exactly. They're burning cash significantly faster than even the most pessimistic models predicted. And if you look at the projections for the future, they don't look much better. Current models show they could burn through $40 billion by 2028.
$40 billion.
And Deutsche Bank weighed in on this, estimating that the company will face $143 billion in cumulative negative cash flow before they ever see profitability.
Wait, hold on. $143 billion in the hole before they make a dime of real profit.
That is the estimate. Their analysts put it quite bluntly. No startup in history has ever survived losses on this scale. It is completely uncharted territory.
That is terrifying. But here's the counter argument I always hear, and I'm sure you hear it too. But look at the revenue. Everyone uses ChatGPT. They are making money, right?
They are, yes. But this is where the unit economics, the cost to produce the service versus what you sell it for, starts to completely break down. Bain & Company did a fascinating analysis on this.
Okay.
They estimate that to make this business viable, given the astronomical infrastructure costs, OpenAI needs to generate roughly $2 trillion in annual revenue.
Wait, $2 trillion with a T.
With a T.
Just to give that context, that is roughly the GDP of Canada or Italy.
Exactly. Or to put it in tech terms, that's approaching the revenue of giants like Apple or Microsoft, companies that have been building for decades.
Wow.
And here's the kicker. Even with the best case scenarios for cost cutting and revenue growth, Bain estimates they can only cover about $1.2 trillion of that.
So there's an $800 billion gap.
Yeah.
Just missing.
A massive, unbridgeable gap. It's a math problem that simply doesn't resolve.
So where's all this money going? Is it just keeping the servers running? Air conditioning?
A huge chunk is going into Sora, their video generation model. We all saw the demos. They were impressive.
Right.
But reports indicate that Sora alone is burning about $15 million per day.
$15 million a day. Just to generate video clips.
Yes. And lead engineers within the project have reportedly admitted that the economics are currently unsustainable. You have to remember, generating video takes vastly more compute than text. It's not just a little bit more. It's orders of magnitude more.
It a furnace for cash.
That's a good way to put it.
Okay, speaking of furnaces, this brings us to the part that actually hits our listeners in the wallet. Because this isn't just a story about a company losing money in San Francisco. This is about why I can't afford a new graphics card.
Precisely. This is what we call the consumer tax of the AI boom.
How does that work?
Yeah.
How does Sam Altman spending billions affect the price of a laptop at Best Buy?
It comes down to the raw materials. OpenAI made very aggressive moves to corner the market on the physical components needed to run these models.
Okay.
They made massive deals with SK Hynix and Samsung, the top RAM makers, to acquire huge percentages of RAM wafers.
For those who aren't deep into hardware, wafers are the silicon discs they cut the chips from, right?
Correct. And manufacturing capacity for these wafers is finite. You can't just spin up a new factory overnight. It takes years. So when OpenAI buys up the supply, they are literally taking capacity away from everyone else.
So he brought up the supply, leaving everyone else scrambling.
Exactly. It triggered a panic. Other companies started hoarding components, creating this vicious cycle.
Yeah.
The result is a massive shortage. If you're a consumer trying to build a PC right now, you have seen this. A 64-gigabyte kit of DDR5 RAM, which used to cost maybe $200, $300, is now hitting over $1,000.
That's a 300 or 400% increase. That is insane. And I saw the numbers on GPUs too, the 5090 model.
It jumped from an expected $2,000 to $5,000.
And it's not just for gamers, right? This trickles down.
It affects everything. It affects these solid-state drives, the SSDs that go into your laptop, your car's infotainment system, your smart fridge. Samsung and others are cutting production, and executives are saying the era of cheap storage is essentially over.
So supply is sold out.
Reportedly sold out through 2027.
So if I need a new laptop, a new car, practically anything with a chip or memory in the next 3 years, I am paying a premium because of OpenAI's burn rate.
Indirectly, yes.
Yeah.
You are paying the premium caused by this artificial scarcity. And this inflation is expected to last until at least 2028.
Okay, so we have a financial black hole and we have a hardware crisis. But usually in tech, the argument is it's expensive now, but wait for the next version. The next version will be so good it pays for everything.
Right, that's the Silicon Valley promise.
But the sources we have suggest the next version isn't exactly delivering.
This is the big math problem that nobody in the industry really wants to discuss openly. We're seeing a breakdown of Moore's Law.
Okay, let's unpack that. Moore's Law is the idea that computers get twice as fast for the same price every 2 years, roughly speaking.
Right. For decades, that held true. Chips got smaller, faster, cheaper. But that curve is flattening. In the world of large language models, it now costs 5 times the energy and money to make these AI models just 2 times better.
That is a terrible exchange rate.
Right.
5 times the cost for double the performance.
And it is getting worse. The low-hanging fruit of easy data is gone. They've scraped the entire internet, every book, every article. To get smarter now, they need synthetic data, which is incredibly expensive.
And we actually saw this play out in public with the GPT-5 launch, didn't we? That was supposed to be the God model.
We did, and it was
Yeah.
awkward. Reports suggest that the large training runs in 2025 failed to produce models that were significantly better. When GPT-5 finally launched, the reaction wasn't awe, it was confusion.
Users called it robotic, boring. I remember reading the forums, people were asking if it was broken.
In fact, it was so poorly received that OpenAI had to restore the older GPT-4o model within 24 hours because users simply preferred it.
That has to be a nightmare scenario. You spend billions, burn massive amounts of energy, lock up the world's RAM supply, and produce a product that people like less than the old one.
It destroys the narrative of inevitable progress, and crucially, it creates an opening for competitors. If you stumble, the shark circle.
Yeah.
And Google's Gemini 3 is reportedly eating their lunch.
I was surprised by how fast that sentiment shifted. You even had Salesforce CEO Mark Benioff publicly announcing he was ditching ChatGPT for Gemini.
That is a massive signal to the enterprise market, and the traffic numbers back it up. ChatGPT saw month-over-month declines while Gemini usage jumped. So OpenAI is losing the technical lead while burning the most cash. That's a deadly combination.
And when a ship starts taking on water like that, people usually start heading for the lifeboats. We've seen a massive talent exodus recently. Is this just normal turnover?
No, this is not normal churn. It's not just the quantity of people leaving, it's the seniority. We are talking about the architects of the company.
Right.
CTO Mira Murati, Chief Research Officer Bob McGrew, Chief Scientist Ilya Sutskever, and President Greg Brockman. They are all gone.
That is essentially the entire founding brain trust. Ilya Sutskever was the visionary behind the science.
He was, and it goes deeper. Half the AI safety team has departed as well. There are reports of executives citing, psychological abuse under Sam Altman's leadership. It signals deep internal turmoil.
And on top of the internal fighting, they have a massive legal battle with Elon Musk looming over them. And this is not just a Twitter spat.
No, this is a lawsuit worth up to $134 billion. A federal judge has ruled that case goes to a jury trial in April.
Remind us what Musk's argument is here, because he was there at the beginning.
It's actually quite simple. He's claiming promissory estoppel, basically a broken promise. He funded OpenAI about $38 million early on under the explicit assurance it would be a nonprofit.
Right, for safety.
Exactly. Now that it's a for-profit entity with a $500 billion valuation, he wants his share. He calls the pivot a betrayal.
If he wins, that could bankrupt the company on its own, couldn't it?
It certainly complicates their ability to raise more money. Who wants to invest in a company that might owe Elon Musk $134 billion? It hangs over them.
So let's look at the board. Financial bleeding, hardware shortages, technical stagnation, brain drain, and massive lawsuits. This brings us to the core conflict. Is this a bubble about to burst?
This is where we have to look at the analysis from investor George Noble. He has been incredibly vocal, declaring code red on OpenAI.
I love that quote he gave. Chaos dressed up in a $500 billion valuation.
It is a biting critique, but it is grounded in market history. Noble argues that the hype cycle is peaking. He points out that the gap between the promised revolution, agents doing everything for us, and the delivered reality, a slightly better chatbot, has never been wider.
And he compares this to the 2008 housing crash.
He does. And that's the comparison that really sticks. In 2008, it was bad mortgages bundled into complex assets nobody understood.
So what's the equivalent now?
Now, it's unproven AI economics, wheedling themselves into critical infrastructure. Noble warns that we are building national dependencies on these data centers. Hospitals, governments, energy grids are starting to rely on this stuff.
So if the bubble bursts...
If it bursts, these companies might demand federal bailouts because they've become too big to fail. They will say, we run the nation's information infrastructure, you can't let us go dark.
But Sam Altman isn't taking this lying down. We have sources from his interview with Brad Gerstner where he is... well, it's pretty defiant.
He is. He challenged the naysayers directly, saying, I would love to see them get burned by shorting the stock. He claims revenue is growing steeply, that they're going to become an important AI cloud.
He seems very confident.
Yeah.
But he also said something in that interview that felt like a slip, didn't he?
He did. In the same breath, he admitted that investors are overexcited and said, someone is going to lose a phenomenal amount of money.
That is not exactly the reassurance you want to hear from the CEO of the company burning the money.
It's a rare moment of candor. It suggests that even he knows the current valuation levels are detached from reality. When you have a CEO admitting that a phenomenal amount of money is going to be lost, it creates a very confusing, volatile picture.
It feels like a high-stakes poker game where everyone is all in, but nobody is quite sure what cards they're holding.
That's a great analogy. And the stakes are getting higher. Remember that Bain projection? To justify their valuations, OpenAI needs to generate $200 billion in annual revenue by 2030.
15 times growth in 5 years for a company already at this scale.
It's almost unheard of. George Noble looks at that and says, I don't see that happening. He suggests the smart money is already rotating out of these big tech AI bets.
So Noble is basically saying, get out before the music stops.
Exactly. He advises trimming exposure to these magnificent 7 AI bets because the risk profile is astronomical. Markets can price risk, as he says, but they can't price chaos. And right now, OpenAI looks like chaos.
Okay, let's bring this all together. What does this mean for the person listening to this deep dive? Because it's easy to get lost in the billions and trillions.
Well, if we synthesize the skeptical view, we're looking at a startup burning billions with no clear path to the revenue it needs. It's hitting physical limits on computing power, that breakdown of Moore's law, and it's bleeding the very talent that built the technology.
And the so what, for the listener, is remarkably tangible. It isn't just Wall Street drama.
No, it's personal. It's the price of your electronics. It's the reason your next car or refrigerator costs more. But there's also a massive environmental toll we haven't touched on enough.
The power usage.
The demand is projected to hit 100 gigawatts in the U.S. alone by 2030. Globally, it could be 200 gigawatts. We are talking about appropriating hundreds of millions of gallons of water for cooling and putting unprecedented strain on electrical grids.
It's staggering to think about. We're straining the grid and emptying our wallets for a technology that, according to the latest reports, might be plateauing.
That is the fear. If the technology doesn't deliver the productivity revolution promised, then we've spent billions and massive amounts of natural resources on a very expensive chatbot.
Which brings us back to that haunting thought from the source material. We all remember the chaos of 2008. But banks are one thing. What happens when companies that are burning billions on unproven economics, consuming massive amounts of national energy, suddenly throw up their hands and say, "We're out of cash, please bail us out"?
It raises the question, have we allowed a speculative asset to become essential infrastructure before it even proved it could make a profit? If the answer is yes, the fallout won't just be financial, it will be systemic.
A sobering thought to leave you with. Is this a tech revolution or just chaos with a $500 billion valuation? We'll let you be the judge. Thanks for listening to this deep dive, and we'll catch you on the next one.
Stay curious.